Hi, in this video, let's look at what's passive investing along with its benefits and limitations. Passive investing is a long-term strategy for building wealth by buying securities that mirror stock market indexes and holding them for long term. In passive investing, an investor would buy index funds like Nifty 50. Nifty 50, for example, is a collection of top 50 companies from different sectors under one index. In passive investing, the passive funds would just copy the list of stocks in the index with similar weightage and try delivering similar returns. Why does one choose passive funds over active funds? To understand this, let's take the example of Nifty 50 and its returns in the first 25 years since its inception. Nifty 50 has grown 15 times in 25 years and has delivered an annualized returns of 11.2% over first 25 years. Benefits of passive funds: lower fees. Passive funds typically have low expense ratios than the actively managed funds. This is because passive funds requires less research and management, resulting in lower operating cost. Diversification. Passive funds offer exposure to diversified portfolio of securities, typically tracking a market index. Consistency. Passive funds aim to track the performance of the market index, so their returns tend to be consistent and predictable over a period of time. Limitations of passive funds: limited flexibility. Passive funds typically track an index and cannot deviate from its holdings. Limited control. Investors in passive funds have limited control over which securities needs to be included in the fund. Lack of opportunity of outperformance. Passive funds are designed to match the performance of a particular index, which means they are unlikely to outperform the market.